Welcome to your own YouTube channel, Romance with Finance, a brand of Financial Freedom Hub. On this channel, you get the videos and information related to personal finance. In our previous videos, we have learned about time value of money, inflation, and smart financial goals. Financial planning is required to ensure that we preserve the value of money with the passage of time so that we are able to beat inflation to ensure that we achieve our financial goals. So now let us understand what is financial planning. Financial planning is the process or the structured approach to manage your money so that you can reach or achieve your financial goals or the life goals. Financial planning starts with a plan. The first step in financial planning process is assessing your current financial situation. It starts by taking a good look at where you are right now by listing down your income, expenses, debts, savings, assets, and liabilities. Think of this like your financial health check. You can't fix what you don't measure. The next step is setting up the smart financial goals. The third step in financial planning process after setting up the financial goals, you need to assess your current financial situation and thereafter you need to assess how much you are saving, how much you are spending, how much you can invest from the amount that you are earning. And then you need to check if you are able to achieve your financial goals within the required time frame that you aspire for, considering the amount that you are able to invest on a monthly basis. If you feel like and you see that the amount is not able to achieve your financial goal, there is a shortfall, then the next step comes into picture, which is investing the money into various asset classes that aligns with your financial goals. Asset classes wherein one can invest in are equity, debt, commodities, currency, real estate, gold, derivative, and alternative investments. Once you have invested money as per your financial goals, you need to keep monitoring your investment's performance and you need to check if it is meeting up to your expectations or not. If you feel like, or you think, or you observe that you are unable to achieve your financial corpus within the required time frame that you set up earlier, then you need to change your investment or your portfolio strategy. At times, you need to stick to the same strategy as well, because when the valuations of a particular asset class is cheaper during that time, you should stay committed towards your investments provided it is aligned with your financial objectives, such as equities, which is the best asset class for long-term wealth creation, irrespective of the fact you invest in direct equities or through mutual funds. Although equity as an asset class is volatile in nature and often a lot of investors are unable to handle the volatility. Thus, during volatility, whenever there is a correction in the markets during that time frame, if you stop your investments or you withdraw your investments, then you are not acting wisely. Wealth is created when you buy at lower price and sell at a higher price. And during the time when markets are cheaper, often it is observed that investors are skeptical to invest money. In fact, that is the time to start investments. And if you are already an investor, then that is the time to accumulate more units through equity investing, because sooner or later the equity rebounds and nurtures the investor's portfolio with huge capital appreciation. So humans' psychology plays a critical role in financial planning process. Let us understand with the help of an example. Let us say that there is a stock in the market which is currently trading at 50 rupees, or there is a particular mutual fund whose market value, that is net asset value, is at 50 rupees, and that will eventually reach at 100 rupees in near future or far future. So potentially there is a 50% of upside potential in it. However, before reaching to 100 level, it may fall to 40 or 30, then it may climb up to 60 slowly and gradually. Thereafter, you get the confidence that the price will now reach to 100. However, after attaining the level of 60, it may move forward and in upside direction till 75, and then it may fall again till 60 or even lower than that, and then it may resume an upward movement again and reaches towards 90. Now this time you are convinced that it will reach to 100 in no time. However, it fall again to 70 level from the level of 90. Now you lose the hope and you withdraw your investments, considering that you have remained invested for such a long time and the return is not as worthy as you expected. Thereafter, once you withdraw your investments from that stock or from that mutual fund, then after some point of time it reaches towards a level of 100, and thereafter it climbs to 150 in no time, and now you are regretting that you should have invested for a little more time. It's a game of regret. Either you will regret while suffering a loss, or you will regret of missing a huge potential gain. That is why you should overcome your psychology and stay invested in a disciplined manner. Stick to a plan and stay invested in a disciplined manner. However, whenever there is a requirement to modify your plan or change your plan, do that, and also, if required, consider a financial advisor. Do not forget to park some money for some risks and contingencies, such as medical emergencies or other emergency situations wherein you need some cash. You should have some money in an emergency fund, which should be in the form of cash or cash equivalents, which is that can be easily converted into cash in no time, considering that those investments are free from volatilities of the financial markets. If the markets crashes during that time frame whenever you are in an emergency situation, then also you should not feel panic because you have cash available with you. By this approach, you will be able to give more time to your investments and you will not be withdrawing your investments in those panic situations, and probably you might be able to invest more during that time frame to gain a huge potential on the upside in the near future or far future. Thus, by parking some of your money in fixed income instruments wherein you can invest for such risks and contingencies events certainly helps to manage the market's volatility. These fixed income instruments are good options to park or to invest your money for the time being. Remember the thumb rule for investments. It is 100 minus your age. The figure that arrives after deducting your age from 100. This is the percentage of amount you should invest in equity or equity related instruments out of the total amount that you can invest. This implies that if you have 100 rupees to invest and you are 25 years of age, then 100 minus 25 is equals to 75. 75% of your money, which is 75 rupees out of 100, should be invested in equities and equity related instruments. And the residual 25% out of 100%, that is 25 rupees out of the 100 rupees that you want to invest, should be invested in other instruments such as debt, gold, fixed income instruments, property, alternate asset classes, etc. Alternate investments includes hedge funds, private equity, venture capital, derivative, crypto, and a lot more. Feeling overwhelmed? The concept of financial planning is vast. We'll make it easy for you through our step-by-step tutorials where on your own YouTube channel. If you think that this video was helpful and you were able to grab some knowledge and you attained some wisdom from this video, then